What are the benefits to a startup of getting acquired by another company rather than going through the initial public offering or IPO process? Well, to begin with, the startup growth model is just that. It is rapid growth. The company seeks investment from outside investors if necessary, but they use every bit of available revenue in the business to achieve growth, because every dollar of revenue can be used to produce growth that has a long-term value that is greater than that dollar. So the very nature of a startup venture is like a project that seeks very rapid growth, and oftentimes the company needs to seek outside investment from investors to achieve this growth, because operational revenue is not enough, and thus the company it is not profitable. It accrues lots of losses during this growth process until it gets to the top of what we call the S curve, the top of the growth chart, where it reaches maturity. And all of a sudden, the growth slows down, the money spent on growth, that is marketing expenses, slows down, and the company can ultimately become profitable and valuable as a company that generates continuous revenue and profit for its owners. Now, the profitability of the firm is uncertain at best. What we have early in its life is growth, and this makes it attractive to mature businesses that are already profitable but have a problem growing, but that they need to expand their market. So oftentimes these larger businesses will acquire startup ventures either for their intellectual property, for their name recognition, or for the market that they already serve. So they seek to grow through acquisition. And once they're acquired, these startup firms do not have to spend all the money on marketing and growth anymore. That is, they are now part of a mature company, and they can immediately be integrated into that company's operations. Also, when the company buys this startup that has accrued lots and lots and lots of losses over the years, these losses can be used to offset the profits of the mature business that's acquiring the startup venture. So this is an important point, that the business, the startup itself, is extremely valuable just because of the number or amount of losses that it has accrued and is captured within the business entity, which makes it very attractive as an acquisition target as well. Now, on the other hand, an IPO would require the startup venture to reach that maturity model and then sell its ownership interest to the public. Now, an IPO, or initial public offering, is very expensive and difficult. It generally requires contacting investment banks to get together an underwriting consortium to go on a roadshow and sell all the shares of the company, and there's no assurance as to whether all the shares will sell and what that will do in the market. So the IPO process is a long, difficult, arduous process where getting acquired by a strategic firm that can integrate these operations and use the tax losses and all of that is just far easier. And oftentimes these strategic acquirers, these mature companies, will pay a higher valuation for the firm to the existing shareholders than they would be able to get in the public market, simply because all of the value that's lost as part of the IPO process is captured there within the firm. It's the speed at which it happens and ease at which it allows these mature acquirers to expand. Oftentimes the acquirer is willing to pay a premium, so it can be far more advantageous to the owners of a startup firm to get acquired rather than go through the IPO process. The other side of the coin is, if the executive group, if they're primary shareholders in the company, if they wish to stay in control of the business venture after the public offering, well, a public offering is going to allow that. After acquisition by a larger company, it's not a sure thing and can be doubtful in most scenarios that the startup team or the current executives in that startup are going to be left in place, that they're going to have a continued job in this bigger company running that business as some subsidiary unit or whatnot. So the executive team loses their jobs. If they're current shareholders, they generally have to sell off most of their interest or exchange that interest for an ownership interest in the acquiring company, and that may not be desirable. So in most scenarios, financially, it is advantageous to get acquired rather than go through an IPO. But if there are other reasons associated with continuing to operate in the business or be a part of the business, an IPO may be a more advantageous or desirable route for the existing management and shareholders.